Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, Ali Mokarabi gives his insights on both Facebook and Alphabet earnings. Kevin McDevitt explores why passive equity funds are seeing outflows, and Christine Benz highlights hidden risks in high-yield investments and shares 3 top stock funds for retirees. Let's get started. Poor guidance sent Facebook shares plummeting on Thursday, but Ali Mokarabi doesn't think the shares are cheap yet.
Facebook reported slightly mixed second quarter results, with revenues in line with our internal forecast but below consensus. It did beat expectations on the bottom line, but Facebook's guidance of margins trending to the mid-30s during the next couple of years as the company will be investing further in innovation, content creation, and data protection was disappointing. Total revenue growth was hampered by slower growth in monthly and daily active users due to the implementation of GDPR in Europe, which was partially offset by higher revenue generated per user. While margins remained at impressive levels, they did narrow year over year, as we had expected and noted in our previous reports. In light of the soft profitability guidance, we lowered our Facebook fair value estimate slightly to $186 per share from $198. Now, we're still confident that Wide Moat Facebook will successfully roll out new products for users and advertisers, and the firm can continue to more effectively monetize its users as it begins to offer more premium video content, not only on Facebook Watch, but also on Instagram's IGTV. Plus, we think Facebook will realize return on its investments in content quality management and data security in 2020 and beyond, resulting in long-term margin expansion. Now, with the stock down about 20%, we now view the shares as slightly undervalued when compared to our new $186 fair value estimate. But we do recommend waiting for a wider margin of safety, likely in the 150 to 160 range, before investing in this wide moat and high uncertainty name.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Mokarabi explores what powered Google parent Alphabet's strong quarter.
Wide Moat Alphabet beat expectations on the top and bottom line in Q2. Ad revenue continued strong double-digit growth as Google is actually monetizing its apps and the YouTube viewers more effectively. Now, we were impressed by the over 40% growth in other revenue, driven mainly by Google Cloud and the consumer offerings. We're confident Google can actually leverage its proven technology expertise, including machine learning, to build and maintain public cloud platforms for various businesses. Its new cloud clients included Domino's Pizza, PricewaterhouseCoopers, and SoundCloud. On the margin front, gross margin is still being pressured by growth in traffic acquisition cost rates, higher spending on YouTube content, and the lower margin hardware offerings. With lower gross margin and continuing increase in headcount and investments in R&D, we actually expect operating margin to be pressured, impacting our fair value estimate of Alphabet, which is now $1,300 per share. Last, the European Commission decided to fine Google $5.1 billion as it alleges Google is forcing smartphone OEMs to pre-install its apps. We think, whether that's the case or not, consumers will keep downloading those apps. While there are no switching costs for users or consumers, the network effects of most of those apps will remain, especially given Google's continuing improvement in search results. So we expect demand for the apps to grow, forcing OEMs to place them on their devices as default, whether forced by Google or not.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next, Kevin McDevitt explains what's driving investor flows out of equity funds.
Hi, I'm Christine Benz for Morningstar.com. Investors have been selling equity funds, and this time around, active equity funds aren't the only casualties. Joining me to discuss the latest trends in fund flows is senior analyst Kevin McDevitt. Kevin, thank you so much for being here.
Thanks for having me, Christine.
Kevin, let's look at the headline where we have seen fairly dramatic outflows from equity funds. And the interesting thing is that we have actually seen some selling among passive funds this time around.
Yeah, that's right. I don't want to overstate it, but you did have outflows of about $3.4 billion last month, and overall U.S. equity outflows were about 21 or so billion. So yeah, it was notable that you had, I mean, again, the lion's share of the outflows came from active funds, but a portion of that was passive. And I think what's really interesting is over the, through the first half of the year, in 3 out of those 6 months, you had outflows from passive U.S. equity funds. And that hasn't happened in years and years. I mean, it's been at least 5 years, and perhaps we've never really seen anything quite like that, where we've seen pretty significant outflows from passive funds in successive months.
Okay. So among U.S. equity funds, would you say the selling was fairly indiscriminate, that investors were selling equity funds of all types?
Yeah, well, on the passive side, you saw the greatest selling from kind of core holdings, core S&P 500 index funds, some total market funds, really kind of the stalwarts of the U.S. equity passive group. While you actually did see a fair amount of inflows from smaller, perhaps more satellite type funds, small cap funds in particular, small blend, small growth, all saw actually net inflows last month. So it's more of those kind of core large blend funds that saw the outflows, at least on the passive side. On the active side, it's more across the board. Again, with active U.S. equity funds last month, you saw outflows of more than 17 billion, and that was more across the board. Large growth continue to see outflows. Really large cap funds of all stripes saw outflows, large value.
One thing we had been watching, Kevin, was the fact that international equity fund flows had remained pretty robust over the past several years, but it looks like there's even been a little softness there recently.
Sure, yeah, it's primarily come from emerging markets, where last quarter or so, emerging markets equity funds are down about 8% with all the volatility there, plus a strong dollar. So that finally has resulted in people pulling money from those types of funds. You had about $8 billion leave emerging market equity funds last month. And that had an impact on overall international equity flows too, which were among the lowest you've seen over the past decade. But year to date, still international equity flows have been quite strong, over $80 billion or so. And that's somewhat curious because overall emerging markets, it's not just because of emerging markets, but international markets are down about 3.7% or so, depending on which index you're looking at. And yet inflows have still been strong, especially into core like foreign large blend funds. Those flows remain strong versus, again, just contrasting that with the U.S. side, where you've had outflows of more than 20 billion year to date, even though the S&P was up about 2.7% through June. There's been volatility there, but nothing like what we've seen in international markets.
Okay. In terms of what investors are doing with their dollars, where they're putting money, fund flows into bonds actually appear quite strong year to date. Let's talk about that. I'd like to hit on the active versus passive divide in fixed income, as well as what types of bond funds investors seem to be choosing. So what categories?
Sure. So if you look at overall taxable bond funds, you've seen strong flows there. Year to date, I believe it's over 125 billion or so. And in terms of the active passive divide, it certainly is there, just not nearly as pronounced as it is on the equity side. So you've seen passive flows of about $70 billion and active flows of about 55 billion. So you've seen a bit of an advantage for passive, but again, nothing like what you see on the equity side. In terms of individual categories, it's very much core, fairly conservative categories. The top category year to date has been intermediate term bond with a little over 40 billion in inflows, but that's followed by ultra short term bond funds, which has seen a little over 30 billion in inflows. And that's been really curious to see, because it really shows, in my mind, does show a shift of investor preferences in terms of risk appetite.
Right.
And that really started about 2.5 years ago when you had a sell-off in high yield bond funds. And ever since then, you've seen decline demand for high yield bond and increasing demand for ultra short-term bond funds as the Fed has been raising rates. So for the year to date, you've seen about 30 billion or so in inflows for ultra short-term bond funds, and about 23 billion or so in outflows for high yield.
How about the fund flows among fund families? Vanguard and iShares have been huge beneficiaries as we've seen this enormous torrent of assets going into passive products. It seems like they've both experienced a little bit of softness recently.
They have, and it's really across the board. I think it's more indicative of just how demand is slowing for kind of long-term assets in general. But yeah, certainly iShares, BlackRock, and Vanguard, as you said, Vanguard is well below or well behind where it was in recent years in terms of first half flows. I believe this past month was its weakest month since August of 2013 in terms of inflows. So you can't really point to any one category, any one asset class, although with Vanguard, they have seen net outflows from their active funds this year, active equity funds in particular. But really, that hasn't been the engine for them anyway. You're just seeing slowing demand, I think, really across the board. So it's hard to really chalk it up to an individual family or an individual, active versus passive. It's really just slowing demand across the board. I think, again, it's a good thing to keep in mind that this first half was the worst first half for long-term flows since 2015 and the third worst over the last decade. So really, it's really been an across-the-board phenomenon.
Okay. One broad last question for you, Kevin, is the fact that when you sort of look at these fund flow trends in aggregate, I think you see that investors appear to be being a little more preemptive in terms of some of their trades, that they're not necessarily driving with the rear view mirror as we've so often seen in the past. What do you think, and it's hard to summarize what investors might be doing in aggregate, but what do you think is driving investors to be a little bit contrarian in their choices?
Well, it seems like they're being certainly far more, not if the word is proactive, but far more active, at least with what they're doing with ETFs in particular. We're seeing big shifts month to month in flows in and out of kind of those core ETF funds. Like I'm imagining like some of the iShares funds, some of the S&P related ETFs. You're seeing big shifts month to month. And it just suggests that whoever is controlling those allocations is being far more active. If that's advisors or quantitative investors being model driven, whatever it is, they just seem to be far more proactive, but also far more risk averse. Again, it's surprising how much money has gone out of U.S. equity funds, even though it's nothing like, at least so far, what we saw during the 2015, 2016 correction or 2011, or even the credit crisis going back to 2009. So really, it just seems like investors are much more aggressive in kind of tweaking and changing their asset allocations month to month.
Interesting stuff. Kevin, it's always great to get your perspective. Thank you so much for being here.
Great. Thank you, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, Christine Benz looks at the pitfalls of some higher-yielding investments.
For Morningstar, I'm Jeremy Glazer. Interest rates may be rising, but retirees are still looking for extra yield to help fund their retirement. I'm here with Christine Benz. She's our Director of Personal Finance to look at where there could be some risks in seeking high-yield investments. Christine, thanks for joining me.
Jeremy, it's great to be here.
So we're going to look at three different types of investments today that might have some risks that investors aren't fully aware of or haven't fully thought through. And the first are high-yielding foreign dividend-paying stocks or foreign dividend-paying funds. Why is this an area that could potentially have some risks?
Well, first of all, we'll start with the attraction, which is that yields can be really attractive relative to U.S. equity dividend yields. So yields are like 4% right now if you buy sort of a basket of high-yielding foreign stocks. So that's a big plus. I do think that investors need to be mindful of the risk factors. Not that they should definitely avoid this category, but a couple of things you'd want to keep in mind. One is that anytime you're looking at a high dividend yielding product or high dividend yielding stock, you're usually getting a little bit of a value orientation. So if you're buying a fund that tracks some high dividend yielding universe, you're going to end up with a value tilt. So that's one thing to keep in mind. You may end up with a little bit more economic sensitivity with that portion of your portfolio as well. The other thing to keep in mind is that you may be geographically less diversified than would be the case if you bought, say, a total foreign stock market index fund. You probably will get a little less Japan, for example, because dividend yields oftentimes are lower in Japan than elsewhere in the developed world. So that's another thing to keep in mind. Mind the geographic exposures. Recognize that you may be making certain bets there by focusing on dividend yield with your foreign stock portfolio. Another thing to keep in mind is that dividend yields overseas tend to be a little more ephemeral than is the case in the U.S., where if a U.S. company is paying a dividend, it will sort of turn over every cupboard in order to maintain that dividend. Not necessarily the the case in foreign markets where dividends might come and go a little more. And this will be a particular issue for investors who want to buy an individual company that is that happens to have a high yield attached to it. So something to keep in mind, and certainly anytime you're talking about yields, whether from bonds or stocks, you want to bear in mind tax consequences as well. So if you are someone who's interested in making a big play in foreign high-yielding stocks, check with your tax advisor to talk about where to hold that particular product or individual security.
And currency risk shouldn't be overlooked either.
Absolutely. Thank you for reminding me. Anytime you have a foreign stock or a foreign fund that is unhedged, you are exposing yourself to foreign currency fluctuations. So there's a chance that your gains, when translated back into U.S. dollars, could be diminished if currency fluctuations break against you. On the flip side, you can also gain if foreign currencies gain at the expense of the U.S. dollar over your holding period.
Let's turn to business development corporations, or BDCs. Can you just describe exactly what these are?
Yeah, technically they are closed-end funds that trade like equities, but I think a good way to think of them is kind of a private equity product for the masses. So they are pools of capital that invest in either the debt or the equity of companies that aren't public typically, oftentimes smaller companies that need some sort of financing. So the big advantage to BDCs, and one of the reasons why they might have come on yield-focused investors' radar, is that the yields can be really tantalizing because, like REITs, BDCs need to pay out 90% of their income to their shareholders each year. So it's not unusual to look at BDCs and see yields of like 9%. Also, there are managed products that focus on BDCs. They too have very tantalizing yields. So that's the big attraction. Certainly there are big risk factors there as well, though.
And around here, 9% yield, that could be more terrifying than tantalizing, raises a lot of red flags. When you look at that number, are these businesses sustainable? Is that yield sustainable? What are some of the risks that investors need to keep in mind?
Yes, such a great point. Anytime you see a yield that high, it's your job to get in there and take a look at some of the risks. In the case of BDCs, these are oftentimes very leveraged companies whose fortunes are leveraged to the strength of the economy. So what we saw in 2008, for example, was many of these companies encountered troubles. BDCs underperformed. Some of them had losses of upwards of 30% during that period, or even more. So you need to be careful. You need to recognize that these are risky companies that BDCs own, and you need to be prepared for them to experience periodic downdrafts because they are so sensitive to the strength of the economy.
Let's dial down the risk a little bit and look at floating rate funds, like bank loan funds. These have been increasingly popular.
Yes.
What are some of the pros of looking at a product like this?
Yeah, the couple key pros here. One is that yields have become pretty attractive on floating rate or bank loan or senior loan products where you don't have to stretch too hard to find a product that is yielding in the neighborhood of 4% today. And the other big attraction to floating rate products is that you do tend to have less vulnerability, much less vulnerability to changes in interest rates. So typically bonds are very vulnerable to interest rate changes. Floating rate products are a little bit different in that when rates trend up, when the LIBOR trends up, so will the rate on the securities in the loans in the portfolio. So they tend to perform pretty well in periods of rising rates. When we've looked at what categories perform well in inflationary environments, floating rate products also look good from that standpoint. So those are the big advantages.
But there's some downsides as well.
Certainly, and some of the same things that we've talked about in the realm of BDCs, although to a perhaps smaller extent, are in play with the floating rate products. So specifically, you get a lot of sensitivity to what's going on in the economy. You get a lot of sensitivity to what's going on in the equity market. So in periods of equity market weakness and economic weakness, what we typically see is floating rate portfolios behave in sympathy with the equity market. So keep that in mind. I think this is a serious category that serious investors should consider, but I would limit it to a small portion of the portfolio and certainly not think of it as a substitute for high-quality fixed income securities.
Bottom line, what should retirees keep in mind who are looking at these higher risk, higher yield type of investments?
I think you hit on it, Jeremy, when you said anytime you see that sort of very high eye-popping yield, that's your trigger to get in there and take a look at what risks might be lurking in the portfolio. So keep that in mind. I think it's also worthwhile if you're looking at high-yielding securities to the extent that you can diversify across a basket of securities. I think that is a great thing to do for your portfolio. And then also anytime you're looking at products with yields attached to them, so any sort of managed product, really focus on keeping the costs down on that product.
Christine, thank you.
Jeremy, thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Finally, Benz shares 3 top stock funds for retirees.
I'm Susan Jabinski from Morningstar.com. Stocks can play an important role in the portfolios of retirees. After all, if you're going to live off your portfolio for 2 decades or more, you'll likely need stocks to provide some much-needed growth during the drawdown phase. Morningstar Director of Personal Finance Christine Benz includes 3 stock funds in her model portfolios for retirees. She's here today to discuss them. Christine, thanks for joining me.
Susan, it's great to be here.
Your retirement portfolios include stock funds in that third and last bucket. And the stock fund that takes up the largest percentage of assets is Vanguard Dividend Appreciation. Why did you pick that fund?
I think of it as a sort of a high-quality subset of the total market. So it focuses on companies that have increased their dividends in each of the past 10 years. And the net effect of that screen is that it tends to focus on companies with sustainable competitive advantages. So when we look at the portfolio, it actually has a much larger share in what we call wide moat stocks than does the S&P 500. It's also a Vanguard index fund, so it's very, very inexpensive. It charges just 8 basis points for the Admiral shares. So it's a cost-effective way to own what I think of as a very high-quality portfolio. It tends to be less volatile than the broad market. So in 2008, it lost 10 percentage points less than the S&P 500.
You know, you also include another Vanguard index fund,
Yes.
Vanguard Total Stock Market, in the portfolio. How does that come into play with the mix?
It comes into play because there are sectors of the market that Vanguard Dividend Appreciation does not encompass. So Vanguard Dividend Appreciation tends to be pretty light on the technology sector, for example. And Vanguard Total Stock Market, of course, just mimics the total market capitalization of the U.S. stock market. So it's not making bets on various sectors. It offers very broad-based market exposure. It's even cheaper than Vanguard Dividend Appreciation. It charges just 4 basis points for the Admiral share class, and it's also incredibly tax efficient. So for an investor who has a taxable component of his or her retirement portfolio, this can be a one and done choice because it is very tax efficient. It comes either as an exchange traded fund or a traditional index fund.
And Harbor International is the third fund. Why that one in particular?
This is a little more controversial, I suppose. It's certainly more volatile, and it has tended to be a little bit streaky when we look at performance. So it has some periods of very strong returns, but periods where returns haven't looked as good. But I think it's a great fund because I believe that its strategy is fundamentally really prudent. So management focuses on companies that it believes has sustainable competitive advantages. It likes to buy them when it thinks they're trading cheaply. And once it buys them, it hangs on and on and on. So it has very low turnover. It's a patient approach. And so I would say investors who like the idea of that strategy need to have a similarly patient mindset because it will go through these fallow periods where performance will look out of sync with other foreign stock funds.
Christine, thanks so much for providing us some perspective on these funds today.
Thank you, Susan.
Thanks for watching. I'm Susan Jabinski from Morningstar.com.
We're taking a brief summer hiatus and will return to publishing on Friday, August 10th. In the meantime, stay up to date with all the latest Morningstar research and ratings by visiting Morningstar.com. From everyone here at Morningstar, thanks for listening.